Australia's housing market is under pressure from many directions, but one of the most overlooked barriers is stamp duty. Look, once it was a relatively modest transaction cost, but stamp duty's ballooned into one of the biggest financial hurdles for home buyers and obviously for investors as well. Now, just to give you an idea, in Sydney, stamp duty on a median-priced house has gone from around 45% of a household's disposable income only in 2000 to around 120% of a average household income today. It's not just buyers who are suffering. Stamp duty distorts housing decisions, locks people into homes that no longer suit them, but they don't want to move on. It acts as a handbrake on productivity. So welcome to another episode of the Michael Yardney podcast, where I like to cut through the clutter of all those mixed messages there to help you make better property decisions. And I'm excited today to once again be joined by Dr Nicola Powell, Chief of Research and Economics at Domain. Her recent report made a compelling case for replacing stamp duty with a fairer, broad-based land tax. Well, she says it's fair. I don't know what you think, so let's find out. So whether you're a property investor, a home buyer, or just somebody who's interested in the housing market, I'm sure my chat with Dr. Nicola Powell is going to give you a different perspective. By the way, I also want to discuss with her her latest report on who's profited from property over the last few years. Again, something that's going to be of interest to you. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Nicola, thanks for joining me. Your report on stamp duty caused quite a stir. Look, it seems like almost every economist agrees stamp duty is one of the worst taxes we've got, and yet despite everybody agreeing it's bad policy, it remains in place. What's going on, Nicola?
It does create quite a stir, doesn't it, Michael, when you talk about stamp duty reform? But you really will struggle to find an economist that actually supports stamp duty. And it is a really disincentive to right-size your home. It's a disincentive to relocate. And we are really supportive of stamp duty reform. And when you look at the burden of stamp duty, it has grown over time. So we're paying much more stamp duty than we were, 10, 15 years ago. And if we shifted to a land tax and removed stamp duty, which really is a major barrier to buying and selling a home, what that would do is it would actually improve the efficiency of housing and the use of land, and it would also boost labour market flexibility. So if you needed to relocate for a job, or you wanted to try and relocate to get better work opportunities, that barrier of stamp duty would be absolutely removed.
Well, just go back a little bit. Stamp duty got its name because many years ago, when contracts were exchanged, the government took a little tax by making you put a stamp on it to make it official. I do remember many years ago, I can't remember, it wasn't a property contract, I was involved in something like that. So it's a state-based tax on all property transactions, and as you correctly say, it's a disincentive because it makes it harder for first home buyers who need more than just their deposit to get in the money, Nicola, but it's also for older people who are wanting to right size or downsize when there's another huge impost. So how has the percentage of stamp duty changed over time? How's it now become even more of a burden? I was shocked by some of the numbers that you came up with.
Look, it is quite startling, actually, when you do that comparison. Obviously, it's different, slightly different depending upon the city in which you live. But let's take Sydney as that example. Back in 2000, the proportion of stamp duty in reflection to the gross disposable household income sat at 45%. Today, it sits at 120%. So gross disposable household income in Sydney is about $62,000, and the stamp duty paid for a median-priced house is $74,000. So it is humongous, and it is slightly different. So in Brisbane, back in 2000, it was 20%. Today, it's 66%. In Melbourne, back in 2000, it was 37%, and today that sits at 109%. So these just highlights the growing burden of stamp duty on your everyday Australian. And there's a concept, Michael, called stamp duty bracket creep, which means that more homes are edging into higher rates of stamp duty over time because, generally speaking, we see property prices move much higher than inflation. And when you think about New South Wales, they've indexed the change of stamp duty to inflation, but we know that property prices move much more significantly than that.
Well, it's interesting how it has become such a big burden, as we said, for people at all levels. I guess it's one of the reasons that we've got reduced housing mobility. I guess there are other demographic reasons as well, but your report highlights that today Australians are holding their homes for around 9 years compared to moving every 6 years, 15 years ago. What's
Yes.
behind this trend, do you think, Nicola?
This is a fascinating trend. Ultimately, Australians are living in their homes, that we're staying put for longer. Now, I think one of the reasons for that is the burden of stamp duty. And we also have, if you factor in a misallocation of housing, which means that we are living in homes that far exceed our needs. So, about 65% of owner occupiers who own their home outright have two or more spare bedrooms. That's a
Yeah.
lot of spare bedroom capacity across our housing market. And I think what's happening is people are making larger property leaps than are necessary for their current life stage. And what that means in kind of layman's terms is you might be a young couple, you're planning to have a family, but you're not going to have that family for 5 or more years. But what you try and do is you buy a larger family home sooner and make that property leap because you're planning ahead. But also, what that means is you are trying to reduce the amount of stamp duty that you pay over your lifetime of buying and selling and transacting property. Because, I mean, stamp duty is tens of thousands of dollars. This is a significant amount of money that Australians are paying.
Now, it's interesting because there's no capital gains tax on the family home, and there's lots of talk in the media and on the forums about nasty, greedy property investors taking advantage of capital gains tax exemptions. But I read a report just this week from some economists who are suggesting we should introduce a capital gains tax on homes because it's the first time I've ever heard anyone say it's unfair that homeowners are missing out on that tax. And this was in light of tenants being disadvantaged because homeowners have got the capital gains tax-free exemption.
Oh, Michael, I read that same one and I thought it was quite wild, actually, because I think if we add capital gains tax to the primary family home, it is just going to exacerbate the issues that we have. It means that
Yes.
people are not going to move, right? If you are unlocking the equity that you've grown in your home, but you know that you've got to pay capital gains tax, you will stay put. And what it will create is less housing mobility, less labour mobility,
Yes.
less productivity, and it will probably mean more of us will stay in our larger homes as, we become empty nesters. I just cannot see having capital gains tax on the primary family residence is the right way forward.
Well, definitely not. I agree with that. Now, some of your research says that around 25% of downsizers are deterred from moving because of stamp duty. We hinted on that a minute ago when you were discussing before that they're in homes that no longer really suit their requirements when the kids have moved out. What does this mean for housing supply?
Look, I do think that this misallocation of housing is a real issue in terms of us right sizing, using our current housing stock efficiently and effectively. I do wonder whether the primary residence might actually end up being part of the age pension asset test, because at the moment it's not. So I think that probably all aspects like that are open for discussion at a federal government level. But I think that the misallocation of housing is very deep in Australia. But I think the other part that is of the conversation, that stamp duty is definitely a disincentive for people to downsize. But the other aspect that is probably more emotional is that we have to remember that some families, couples, individuals have lived in a community for decades and they want to stay in their community. But often it's not necessarily just the stamp duty issue that stops someone from downsizing. I think it's the fact that we don't have a diverse array of homes. There just isn't the
Yes.
right type of home available for someone to downsize into their neighbourhood. They want to keep their same doctor, dentist, go to the same bakery that they have done for the past 30 years. And I can understand that. So, I think for housing supply, obviously if we encourage downsizing, it would free up larger family homes and we'd get that turnover of housing stock. And it would mean that we would also be right-sizing our homes more. But I also think it comes back to the types of supply that we're currently building across our major capital cities and where they are.
Guess that's why us baby boomers like to call it right sizing rather than downsizing, because it's not necessarily moving to something smaller, but often on the one level, close to
Mhm.
shops, close to amenities. And yes, we want to stay close to the same hairdressers and doctors and dentists that we go to. Nicola, in your report, there was something that shocked me, surprised me a little bit. You said stamp duty is highly inefficient. You said it costs 70 cents in lost activity for every dollar raised, compared to less than 10 cents for a land tax. Could you unpack that for us, please?
Look, there's been some research into this, and it's not just the fact that stamp duty is unpopular. It is one of the most economically damaging taxes in Australia. So, as you mentioned, for every dollar raised in stamp duty, around 70 cents of potential economic activity is lost. And if we transition to a broad-based land tax, it would cost the economy less than 10 cents. So the shift is quite evident. And I think really, one of the core things here is, and probably what these figures are actually highlighting, is the fact that stamp duty really does reduce housing mobility. It exacerbates the housing mismatch, it discourages housing investment, and ultimately it really does hurt productivity and wage growth, because this is the concept where it really does limit the ability of workers, of Australians, to relocate to where their skills are most needed. And that really does reduce the dynamism in our labour markets and across our cities.
Now, of course, the state governments are addicted to land as a stamp duty because it's what's been giving them lots of money. Land tax, I guess, would have to be phased in, because some people would argue, hey, I've already paid stamp duty for my home now. It's not fair that you suddenly tax me again. Interestingly, the ACT is the only jurisdiction that actually fully committed to phasing out stamp duty. I think it was a 20-year reform, wasn't it? What can we learn from that, Nicola?
Look, they definitely are on this pathway to reform. It's a 20-year reform. They're roughly about, halfway into that reform. But the thing the ACT government has that's different is really their unique governance structure. It combines both state and local government functions. So it's much easier for them to do things like this. I think that what we can learn is the approach, I think, needs to be staggered over time. My personal opinion is I do think we have to have some kind of grandfathered nature to stamp duty. Otherwise, it's technically double dipping in terms of taxation. So I think for those that have recently paid stamp duty should be exempt from paying higher rates of land tax, because you cannot ask somebody who's just paid tens of thousands of dollars to then stifle up an escalating land taxation bill every single year. So I do think that there needs to be a grandfathered approach. And the ACT, they're going on this slow burn of reducing stamp duty rates and increasing land taxation. I think, though, it's hard for the other states and territories because they don't have that unique governance structure. And actually, I think if we are really serious about stamp duty reform, it needs to come from a federal level. It needs to be supported on that federal level, because I don't think it's going to happen otherwise.
Well, it should be remembered that stamp duty and land tax are both state-based taxes, so the states have got the right to change the taxes. I'm not sure that they've got the will to do it politically, though, do they?
They don't. Look, let's be honest here, Michael. I think it's going to take brave politics and really forward vision thinking around kind of the productivity, not only in our labour mobility, but also in our housing markets moving forward. And, as you said, you pretty much opened this conversation with talking about it's very hard for a government to wean themselves off stamp duty because it provides such a large revenue. And that's why it's going to be bold. It's going to be bold for other states and territories to follow the ACT. But ultimately, out of all of our states and territories, at the moment, the ACT is leading the way in reform.
Now, Domain brings out a lot of reports, and I'm going to leave a link to your next report in the show notes for this. But you analysed what's happening when people sell their homes, and you're now doing this every 6 months and seeing who's making a profit and who's not. What did the most recent Domain report show?
It's probably not going to surprise you at all, Michael, because I think my key take home was really it demonstrates how property property is a way to build family wealth and prosperity. We found and we analysed the first six months, so the first half of 2025, 97% of houses that were resold sold at a profit, slightly lower for units at 88%. And when you looked at those profit levels, they are significant. And even actually, when you look at the proportion of profit-making resales for houses, that's the highest levels that we've seen in about 2 decades, which is extraordinary. And when you look at the dollar gain, the median profit for a house Australia-wide, so national, $365,000, units $202,000. And that's the median, right? We've got to remember there is going to be lots of people
Yes.
above that figure and lots of people below that figure too.
So one of the factors that were highlighted in your report was holding periods to determine profit. Now, that makes sense. Was there a sweet spot when maximum gains were made?
Look, that's a hard one to answer. I think ultimately, the longer you stay in the property, it allows you to realise those capital gains, that equity growth. I also think it is about timing the market too. And what we have found that, we have got tenure lengthening, which means that you've got a longer period of time to, see capital growth within your home. The average tenure period for a house is 9 years now, 8 years for units. When you compare that to 15 years ago, it's up 3 years for houses and 2 years for units. So that allows homeowners the opportunity to build equity and realise those capital gains. And it also means that you're riding a handful of property cycles there. So you're realising not only the upswings and it counteracts those downturns that we do see. But one of the big things that we do know is upswings always out-trump a downturn anyway.
Well, I guess it shows what Australians do with their homes. There's been a lot of talk about how hard it is for first homeowners to get into the market, and there's no doubt it is. But if you look over the last 12 months, there were something like 560,000 transactions occurred,
Mhm.
property transactions according to PEXA, and there was about 110,000 first home owner loans taken out. So there was still quite a significant percentage of new transactions happening for first home
Mm.
buyers. But then people don't buy their final home, their forever home. So as their lifestyle changes, as they have more children, as they move location for jobs, people move homes. But clearly what you said is it does give them the ability to create wealth for themselves and intergenerational wealth. But as you dug down into the details in your report, was there a difference between capital cities and regional markets in terms of resale profitability?
Look, there was. When you looked at the profitability in terms of the proportions for houses, they were very, very similar. They were both at about 97%. The dollar gain, the median dollar gain for a house was quite different. In regional markets, it was $280,000. Across our combined capitals, it was just under $440,000. But the interesting aspect here is when you start to talk about units. And, generally speaking, you tend to find that houses see greater capital growth over time. But I think in the unit sector, what was quite interesting when you do the capital city versus regional market comparison, it really shows the power of location. Let's think lifestyle locations here, which ultimately means that regional units are seeing greater capital growth and greater median gains and a greater percentage of profit-making resales than our combined capitals. And that actually took me a bit by surprise.
Interesting, yes.
Our regional markets trump here for units. So 96% of units in regional markets sold at a profit, and that profit was $225,000. In our capital cities, the proportion of profit-making resales was at 86%, so quite a bit less, and even the median profit was lower at $195,000. So for me, this just says location is everything.
There's nothing new about that, is there? Of course, it's more than location. It's owning the right properties in that location. So summing it up, we've had a chat only a month ago about your recent domain reports and forecasts for the next year. It looks like now the most recent interest rate drop has increased consumer confidence. Each weekend, Domain bring out your reports on auction clearance rates almost at boom time levels. There's a lot of confidence has come back into the market, Nicola.
Absolutely. I think everything that we were talking about last time, we were quite bang on, weren't we, Michael? We were seeing that momentum come
Hey,
back
we got
in.
it right.
We did. Clearance rates have consistently risen. We've obviously had another cash rate reduction delivered. I think that foundation now is provided for quite a robust spring selling season. And you've got that confidence coming back. I mean, consumer confidence is now almost into positive, which is extraordinary. And we know that when consumer confidence is rising, and particularly when it hits into positive, that plays out historically well for our housing market. So, look, let's watch this space. I think we're not going to probably see boom time price growth, but I do think that we're going to continue to see price growth for the rest of this year and into next year too.
And as you put in your forecast there, reasonable price growth, not expecting another boom, but a period of sustained property price growth. So, Nicola, thanks again for joining me today. I think your research made it crystal clear that stamp duty, it's actually more than a nuisance. It is a drag on home ownership, on mobility, and that does affect the broader economy. There is a spin-off effects. And I guess it is encouraging to see that reform is possible if you look what's happened in the ACT. But I, like you, believe it's going to be a challenge for politics locally and for federal politics as well. They've recently had a roundtable discussion about what's going to, some tax reforms. I'm not sure that stamp duty was part of that. And also, I think your work on the resale profits is another reminder for property investors that the key isn't speculation, just own the right properties over the long term. It's always a pleasure having a chat with you. I'll leave a link to the various domain reports in the show notes, and I look forward to catching up again soon.
Thanks so much, Michael.
If you're a regular viewer or listener to this podcast, you'd know that each week I ask a property trivia question, giving you a chance to win a copy of one of my books. I'm going to ask you the question in a moment and then go to propertytrivia.com.au. I'll leave a link in the show notes, enter your answer, and each week 3 correct answers win a hard copy of, at the moment I'm giving away Michael Yardney's Guide to Investing Successfully. And don't worry if you're listening to a slightly older episode, your entry will still count. Also, everyone gets a copy of a report I've just updated. Here's this week's question. It's a little bit tricky. Which Australian state has the highest land tax threshold? Which Australian state has the highest land tax threshold? And I'm going to give you a clue to make it easier for you. This state has no land, or location has no land tax at all, so it's got a very high threshold. Go to propertytrivia.com.au and leave your answer. I always enjoy my chats with Dr. Nicola Powell, and clearly our housing market's going to have a couple of good years ahead of them. We know that the Reserve Bank cut interest rates for the 3rd time this year, and history tells us exactly what's going to happen next. When money gets cheaper and confidence returns, buyers rush in. Look, we've seen it every time. More buyers enter the market, competition heats up, prices rise. And of course, smart investors aren't waiting for the headlines to say how much the markets have moved. In fact, they've been moving all this year already anyway, haven't they? And with a couple more rate cuts to come over this cycle, and with at the beginning of next year, the new first homeowner grant's going to be pushing a whole wave of new people into the market. We're at the beginning of what I see as a prolonged period of property price growth. So I'd like to allow you to have the opportunity of taking advantage of this by having a wealth discovery chat with one of the wealth strategists at Metropole. Look, we've been helping clients through multiple property cycles, and we know that this is a great time to get in before the bulk of the crowd does. This is when the opportunities are best. Right now, our clients are positioning themselves to secure quality properties, while others are still waiting and watching what's happening. You could be doing the same. So book your wealth discovery chat, go to metropole.com.au and leave us your details. Whether you're buying your first property, adding to your portfolio, even if you're looking for a home, we're going to actually explain to you how we can help you create a personalized strategic plan, how to identify the right opportunities, navigate the property markets with confidence and clarity. Metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message this week, I want to explain to you the importance of having a growth mindset. To make the next years of your life the best years of your life, I believe it's going to be critical for you to have a growth mindset. I want you to think back. way back in time. Go back to maybe when you were a child. Hey, are you there? Now, I want you to think about what you didn't know as a child. The list was very long, wasn't it? At some point, you didn't even know how to tie your shoes, let alone anything about the property market, success, money, or what makes a good investment. But here you are today. You're in a job, you may have children, you're good at what you do, people rely on you, maybe your children, your spouse, your parents, your clients. But I've got a question for you. You help other people learn and grow, but how committed are you to learning new things and to growing? There's this thing called a growth mindset. You have to have a growth mindset if you believe your talents can be developed through hard work, through good strategies, and through the input of others. This means you think you can do more, learn how to do things better. On the other hand, people with what I'd call a fixed mindset believe their talents are their innate gifts. In other words, you're stuck with what you've got. Now, I understand why some people default to a fixed mindset. Learning new things can be hard. But because you're right here, right now, learning something new, you know it's possible. You're listening to this podcast because you want to learn new things. So I feel pretty confident saying that you've got a growth mindset. So with that in mind, I want to encourage you to think about a couple of things now moving forward. First of all, you're not perfect, so you're going to fail sometimes. Now, failure can lead to criticism. Criticism can trigger a fixed mindset. Hey, that's okay. Give yourself permission to fail, but commit to identifying the triggers that are going to switch you from thinking growth to thinking fixed and avoid those. Number two, you won't have a growth mindset about everything. There are just some things I'm bad at. More practice just not going to help me that much. And you get frustrated. That's okay. For some things, you may just have to learn to let go. Like the idea in the back of your head that you can figure out a way to time the property markets perfectly or find that perfect investment property. Look, we're human, and part of being human is pushing to get better than we were in the past. And by adopting a growth mindset, you can find a path forward that helps you become better, become a better person, a better communicator, a better parent, a better friend, a better partner. So adopt a growth mindset and have a great week. Make it a great week. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Well, just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favorite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?